with the onset, the last change took place with the onset of the Industrial Revolution. Prior to the Industrial Revolution, the ratio of per capita income between rich and poor countries was not high, maybe in single digits. In 1800, it was like 1 to 2. By 1950, it had gone up to 1 to 20. That is the ratio between per capita incomes of rich countries and poor countries. And the world, of course, had got increasingly divided into rich and poor. There had been colonialism, imperialism, etc. in the 19th, 20th centuries. And Europe, and in that period, of course, Europe was on the ascendant. Between World War I and World War II, power shift, it took about 30 years for power to shift from Europe to the US. And in that period, there was a huge amount of confusion. And in some sense, that's kind of the issue that is facing us, that are we on the verge of power shifting from Europe and the US combined towards Asia, or in some sense to the Pacific, from the Atlantic Ocean to the Indian Ocean. After World War II, power, of course, clearly went from Europe to the US. US was clearly on the ascendant. And the question now is that how is the new change going to come about? This change has been happening since the 60s, but much more slowly. First, Japan grew very fast, then the tigers, Korea, Singapore, Taiwan, Hong Kong, then China and India have come into being. The interesting thing is that even though there was very high growth in China right from 1980 onwards, it didn't make much difference. It didn't make much difference to the collective weight of the advanced economies in global GDP till around 2000. Since around 2000, the collective change that is taking place in the weight of BRICS, the Asian countries, China, relative to advanced economies, has become very rapid indeed. And to my mind, that's sort of the reason why this uncertainty is now taking place. The world is having great difficulty in understanding this change, in being able to cope with it, and therefore there is a great deal of uncertainty. This rapid change over just last 20 years, G7 on the one hand, BRICS on the other, or take advanced economies to emerging markets, it's really reversing the economic hegemony enjoyed by Europe and North America for over 200 years, and therefore I'd call it an epochal change. And it's because of this rapid change taking place that the emerging market countries are demanding much greater representation in the governance of global, of the global economy. Now, one thing that is different, of course, is that even though the weight is increasing of GDP, per capita incomes are still very different. Of course, per capita income is also growing faster, but there's still a huge gap between per capita incomes of, say, China and the United States. But nonetheless, given the increasing weight, there's much greater demand for more equitable distribution of global economic power. There was, as I said earlier, if you look at the history, there was a great deal of confusion on global economic governance between World War I and World War II. There was really no agreement on anything in that period. Whether it was monetary policy, whether it was exchange rate policy, whether it was fiscal policies. Between World War I and World War II, every country was on its own. And although to some extent, I suppose the fiscal policy was indeed on the ascendant. Now, after the World War II, with the Bretton Woods, the global institutions came into being. As we all know, the IMF, the World Bank, GATT/WTO, and that has been the sort of governing structure since then. But you have to remember that in all those institutions, the power structure essentially reflected the post-World War II power structure, that is the dominance of US and Europe. China and India did get among the top 5 board seats right at the beginning in the IMF and the World Bank. But Russia withdrew soon after. The Chinese seat went to Taiwan, and of course there were no communist and socialist countries in the IMF, in the system until around 1980. The economic policy trends kept changing as well, from import substitution to more open trade, more open markets. The exchange rate system went from Bretton Woods' fixed exchange rate system to more flexible exchange rate systems in the 1970s. And only what we need to remember is that in the 50s and 60s, there were not that many financial crises. So the IMF didn't have much work in the 50s and 60s. They had some rescuing of some European countries during that time. It's only after the flexible exchange rates came into being more and continuing flexibility in capital flows that there were many more financial crises, about 100 financial crises incidentally, in the 80s, 90s, and 2000s. And so it became more important for the IMF to be in operation. The Reagan-Thatcher revolution did bring ascendancy to, in some sense, agreement on the Washington Consensus, and it got intensified with the fall of the Soviet Union and other socialist countries. And again, with all the instability that took place in the socialist countries after 1990, once again, IMF was in action in terms of all kinds of different programs. Now, the original intention, what is interesting here is that the original intention of these institutions was to be inclusive, but they were not inclusive till the 1990s. There were 40 original members. In China, India were indeed among the top 5 countries. Originally, of course, the Axis countries were also excluded, but Germany, Italy, Spain, and Japan were included right in the 1950s. But both India and China did not grow fast between 1950 and 1980 and lost ground. So that brings us to the current impasse. The main issue that I'm essentially focusing on is that the change is inexorable. That is, the weight of the Asian countries in particular, China, all of ASEAN, India, Bangladesh, Pakistan, Indonesia, all this combined is going to continue to grow. And we have great uncertainty facing us in the future. We've already seen some changes in the sense of the AIIB coming into focus. The European, the ESM, the European Stability Mechanism, actually has higher core resources in principle than the IMF. So to some extent, Europe is also, through that system, withdrawing from the system. With the establishment of the AIIB, as I said, plus the New Development Bank from the BRICS, the system is going to be in flux in terms of how the world is going to be governed. And so the discussion on what happens in the future and how that if the existing global institutions like the IMF, the World Bank, etc., don't respond adequately to the kind of changes that are taking place in the global economy and are more inclusive and give much greater actual weight and voice to the emerging powers, then there will be the dissipation of global economic governance into many different blocks in the world. To some extent, I've also often argued that the world needs the United States to take much more leadership. Now, with Mr. Trump coming in, it's very difficult to say that you want leadership from Mr. Trump. But nonetheless, the world economic governance system over the last 70 years since Second World War has been relatively stable because of the leadership provided by the United States. The question is, will it be feasible in the future for the United States and Europe combined, will they be able to have the kind of coordination and agreement with China in particular and China-India combined, if we still have the illusion that we're going to catch up with China, which we won't. The size of China is all 4 times than we are. And so for the next 30 to 40 years, here, that you can see here that what the prospects are in terms of the kind of relative weights we will have. But what is clear is that China and India combined relative to the US whether you take 2030, or of course, if one is daring to make predictions to 2060, which I normally don't, but to the extent whatever numbers that exist, these are the kind of predictions people are making, that is going to be a very, very different world. It was relatively easy in some sense for there to be cooperation in global economic governance between Europe and the US because of many commonalities between their cultures. That's not going to be the case with Asian countries coming up. And so there's an open question for what kind of methodologies, what kind of institutions we will devise, which will mean much greater reduction of Europe and greater importance to both the United States on the one hand from the West and China from the East. How will countries like India respond to this? Will we have to invent new institutions, global institutions as opposed to Asian institutions? Will it be the case that you will have different kinds of institutions in different parts of the world, different regions, which will then have to cooperate with each other? I think these are all the open questions that remain. And of course, with Mr. Trump's ascendancy, everything has become even much, much more uncertain. Thank you.
Thank you. Thank you very much. May I request Professor Chinta Subramanian, please?
Good afternoon, everybody, and let me take this opportunity to thank the organizers, Rajat and Dr. Ahluwalia, of course. So I'm going to focus on macroprudential policy. I know Errol and Ashima both have spoken at length about this. Hopefully, I'll give you a slightly different perspective. And I'm going to sort of focus on the interaction between macroprudential policy, monetary policy, as well as international capital flows. So the conventional wisdom, as we all know, pre-2008, was that the central bank's objective function was limited to using a single instrument, which was the interest rate, for achieving largely a single objective, which was price stability. But of course, we also know that financial instability occurred despite inflation targets being met in most advanced economies. So then the thinking slightly changed, the perspective changed, and then central banks essentially now found themselves saddled with two objectives: financial stability as well as price stability. And if you have two objectives, as academic literature, pioneered by Tinbergen suggested, that you would need two sets of instruments to achieve both ends satisfactorily. So the additional set of instruments broadly designated for financial stability were given the title of macroprudential instruments. The purpose of macroprudential instruments was to reduce systemic risk. Now, there are two key aspects of systemic risk. One is the time series dimension, that is the pro-cyclicality of the financial system, which results in excess risk-taking in booms and excessive deleveraging during busts. Another is the sort of cross-sectional perspective, which is that there is the risk of contagion due to the simultaneous failure of financial institutions. Accordingly, macroprudential policy is thought of as a set of tools that largely helps reducing these two forms of risk. Macroprudential tools or policies might be new to the advanced economies, and as Ashima mentioned very correctly, it's not true as far as emerging markets are concerned. In fact, this table, which is taken from the BIS, suggests that a lot of these tools are already in place in emerging economies. A very famous example of the use of, say, loan-to-value regulation was by the Hong Kong Monetary Authority. As you know, it had a very hard peg, couldn't use interest rates to counter rising real estate and other associated growth of rapid bank lending, so it resorted to using the loan-to-value ratio. Right. Equally important, and I think not spoken about as much as it should be, is the Indian experience, the Reserve Bank of India. The RBI introduced measures to restrain credit growth for housing, for consumer finance, to reduce excessive speculation in equity and commodity markets, and so on and so forth. In fact, as we all know, Joseph Stiglitz most famously said that if Dr. Y.V. Reddy was the chairman of the Federal Reserve, there would be no 2008. So as an economist, of course, one would like to think that macroprudential policies or tools are largely used to correct a market failure. So the emphasis on market failure that arise because of interaction between financial institutions also help to clarify why microprudential regulation is not enough to contain systemic risk. Microprudential regulation largely focuses on individual stability of the financial institution, not on systemic risk. Hence, there is need for an additional macroprudential regulation to try and reduce this market risk. Now, the literature broadly allows us to classify such externalities which arise out of market failure broadly into three categories, right? One is strategic complementarities that arise. For example, Rajan at this paper, which says essentially if bank managers care more about the market perception of their ability, their credit policies may be influenced by those that influence other banks. Fire sales, the general sell-off of financial assets causing a decline in asset prices and a deterioration of bank balance sheets. And finally, interconnectedness, the risk of contagion caused by propagation of shocks through systemic institutions. So what the literature has done is it's taken these broadly three types of market failures and has basically mapped them into macroprudential tools. For example, if you have strategic complementarities, then it suggests that capital requirements or liquidity requirements or restrictions on the activities of assets or liabilities would be the appropriate macroprudential rule. So similarly, if you have fire sale of assets, then capital requirements or liquidity requirements would work better, and so on and so forth. So this is a nice sort of mapping that the academic literature has done between macroprudential tools and the kind of externalities that it's trying to address. Now, one thing that emerges from that table, of course, is that capital surcharges or capital requirements, more than any other tool, can be effective in dealing with any of these externalities. And sort of that's why you find capital surcharges or capital requirements being so fundamental as far as Basel III is concerned. Okay, so for example, capital requirements induce banks to internalize more of the cost of engaging in costly lending. However, since capital requirements may become less effective during booms, why? Because capital ratios tend to increase due to buoyant asset prices, then direct quantity restrictions such as DTI or LTV ratios can also be useful complements. These restrictions directly affect the asset side of the bank's balance sheet and are meant to limit the fall in lending standards during boom times. What also emerges from this analysis is that there is no single instrument a priori, there's no silver bullet, but a combination of these instruments that is more appropriate in handling systemic risk. So what that also, of course, brings into question the quantitative significance of these instruments and how does one use them in combination. Now, the link between monetary policy and macroprudential policy. So one view is that monetary policy should aim at a single objective, which is an inflation target. The corresponding policy instrument is the short-term interest rate. Macroprudential policy is complementary with a different and more broader objective of financial stability and a whole range of instruments. Proponents of this view largely argue that monetary policy should simply ignore financial stability as it may distract from the control of inflation. Swenson, 2014, for example, says monetary policy cannot achieve financial stability by leaning against the wind to solve debt problems. And he said this in reference to Sweden's economy, which experienced inflation persistently below target, coupled with an extremely high and growing level of household debt. The Swedish central bank followed a tighter stance of monetary policy than it would have were it purely be based on macroeconomic conditions. So what this has done is, of course, this has resulted in a more gradual return to inflation and unemployment goals in order to reduce potential risks to the financial stability stemming from Sweden's very high level of household debt. In fact, what the subsequent deflation has done is actually it has increased the real value of household debt in Sweden. There is the opposing view, which says that monetary policy should take into consideration financial stability. Monetary policy affects financial stability through incentives to take risks. This has now become more famously called as the risk-taking channel of monetary policy. Essentially, low interest rates may provoke investors into a dangerous search for yield as they seek to achieve targets for returns that cannot be met by holding low-yielding, relatively safe assets. This is particularly relevant when economic agents anticipate that low interest rate environment will persist or that monetary policy will be eased in the case of market turmoil, the so-called Greenspan put. What also needs to be kept in mind is that macroprudential policy could also affect the transmission of monetary policy. For example, changes in the loan-to-value ratio or the debt-to-income ratio could alter the supply of lending and therefore affect demand. Moreover, by changing credit conditions, macroprudential policy could also influence the relevant real interest rate, thus modifying the monetary policy stance even in the absence of any direct policy changes. These linkages, of course, need to be understood clearly before formulating policy. Most of the experience with macroprudential policy to date has come from the banking sector. Ashima has already alluded to this. We need to be alert to continuous changes in the financial markets and the emergence of new risks. There's relatively little knowledge as to what policy measures could be taken to address the buildup of financial excesses that originate outside the banking system. Credit intermediation is moving away from the banking sector to the debt securities market. Globally, debt as a share of GDP from households, non-financial corporates, and governments rose from 216% of GDP at the end of 2007 to about 230% of GDP in 2016, so it's a rise of about 20% points. The shift is especially pronounced for emerging markets, excluding India, of course, and its corporate borrowers, where international bond issuance has gained a lot of ground post-crisis. While the implied financial market deepening and a diversification are a welcome implication for financial stability, the implications of financial stability, I think, are still unclear. So the question to be asked is a market-driven boom more or less risky than a bank-driven boom? Finally, let me come to the open economy aspect. A key tenet in international macroeconomics and finance is the trilemma. In a financially integrated world, fixed exchange rates export the monetary policy of the center country to the periphery. The corollary is that under free capital mobility, floating exchange rates enable monetary policy independence. But does the scale of financial globalization, in particular the role of global banks, put this even into question? So do monetary conditions in large financial centers such as the United States shape global financial cycles via cross-border capital flows? And there's a very influential paper by Helen Ray, who argues that the effect of global financial cycles are so severe that it has largely negated the monetary policy trilemma, and countries now basically face what is called as a dilemma. If a country wishes to have monetary autonomy, it must sacrifice openness. There is evidence that cross-border capital flows reduces the effectiveness of financial stability policies. The proposition that efficacy of financial stability policies is weakened in open economies follows from the so-called financial trilemma. And what the financial trilemma essentially states is that only two of the following three could be enjoyed simultaneously. You could have national control of financial policies, financial integration with the global market, and financial stability. So now the monetary trilemma has largely been replaced by the financial trilemma. For example, restrictions on lenders within one jurisdiction becomes redundant if foreign lenders can enter the market and operate without restrictions. Direct limitation of residents' domestic foreign currency borrowings is less effective if the same entities can issue foreign currency debt in offshore markets. The financial cycles of countries are not perfectly aligned. This means that countercyclical buffers will be imposed in different countries at different points of time. This has implications for internationally operating banks, which can easily move capital across borders. So one solution, of course, and this is where the global cooperation comes in, Basel III's countercyclical capital buffer attempts to address this issue. The relevant exposure measure is a weighted average of an institution's exposure to different jurisdictions. Specific reciprocity clauses handle this so-called inaction bias. Okay, I think I'm sort of running out of time, so I'll end here. Thank you.
Dr. Jayamani Bhagwati, please.
Thank you, Chair. A very good afternoon to you all. There's a good reason why I don't have a slide presentation. I was supposed to chair this session, but once we came to know that Dr. Reddy would happen to be here in Delhi, there was no question of anyone else chairing the session other than him. So I'll try to say a few things, either because they have not been mentioned or even though they have been mentioned, they come to my mind. The session is Global Financial Architecture and Regulatory Practices. Let me kind of narrow that down. And it is in the context of the G20 summit, which, if I remember right, will take place on the 6th and 7th of July, next month, in Hamburg. And sometime in March of this year, I think the head of FSB, the Financial Stability Board, Mark Carney, he sent out a letter stating his views. As we all know, the FSB took its current shape and form after the 2008 crisis. The G20 existed before that, pardon me, but it was raised to the summit level, and we are going to have a summit level meeting next month. So what did Carney allude to in his letter, which is available on their website? I think just prior to the meeting of the finance ministers and governors of central banks in March of 2017, he talked about shadow banking. He talked about over-the-counter derivatives. I'm just pulling out the main points of Carney's letter, and he talked about misconduct risks. I suppose misconduct here refers to cheating and stealing. That's a polite way to put it. He, however, did not talk about UMPs, the unprecedented monetary policies of keeping interest rates at the levels they are now since 2008, and the kind of risks that poses. Shadow banking, Professor Goel has already spoken about that, but my sense is that we don't yet at least have the full contours of shadow banking, and if you include the conduct of tax havens, and I won't get into which are the tax havens. We all know where they are, and they are in quite a few developed country jurisdictions. None of that somehow gets into the work of the groups within FSB which are looking at coordinating policies. It's unfortunate, but I suppose we can guess the reason. Moving on from there, more towards India, what can we watch out for, learn, or improve on? As far as over-the-counter derivatives are concerned, the world wants to move, or so the FSB says, to have swaps and other over-the-counter derivatives traded on stock exchanges. That has not happened because the industry doesn't want it. There are huge margins in OTC derivatives as compared to exchange traded, and they have resisted that. But we in India can make our own efforts. The OTC markets in India are still developing. The maturities are still relatively short as compared to markets in developed countries. But let's see what we can do. As far as misconduct risks are concerned, which is the misalignment of incentives, high bonuses if the company does well, if the financial firm does well, and then you make enough money for one lifetime or more, and it doesn't really matter what happens to the firm later. I think we began, to some extent, because our financial sector is public sector dominated, we don't have that risk to that extent, but we should watch out because I notice now in stock exchanges in India, whether it's the National Stock Exchange or whether it is the Bombay Stock Exchange, the remuneration and bonuses are reaching levels for India which are inconsistent with what you could say is reasonable given what everybody else is receiving in the economy, given, for instance, what the chairman of the State Bank of India receives. Is it a good comparison? I don't know. But I think getting a misalignment of remuneration with the rest of the economy is not a healthy situation. And maybe somebody in government and in the RBI can look at that. The other aspects of the financial sector in which India differs from the rest of the world is the fact that our financial sector is dominated by the banks. And within the banks, the public sector banks. And I don't need to go there and what it means in terms of G20. I'm just saying that what we need to do ourselves to guard against the kind of liquidity, mainly liquidity, that's what triggered the 2008 crisis as money market funds broke the dollar, in the sense that the shares of money market funds that people held went below par value. And that's what triggered the run of the money markets as distinct from a run on a bank, and later on led to a run on Lehman Brothers and so on. So what can we do in terms of liquidity as distinct from solvency as we look at our own financial market, which is bank dominated, within that PSB dominated? I won't go into that whole debate because that's very little to do with G20. But in terms of international cooperation, in terms of international financial architecture, capital markets, I think we are comparable to most other international markets, not in terms of size, but in terms of the technology involved. But I can't say the same about pensions and insurance. They're really, really backward as compared to even medium-sized economies around the world. And this is not because we don't have the expertise. LIC is the behemoth for insurance, and unfortunately, it's asked to invest in equity quite often. It has, right now, for instance, very high amounts of investment in public sector banks, well beyond what you would expect. A life insurance company which will have demands on it which would be very different from what you could service given the proportions that you have invested in equity. However, given the fact that if the LIC were to tomorrow do a public issue, it will become the largest company in India by far. It probably be 5 times the size of Reliance or 10 times the size of most other companies in Sensex. Having said that, do we need to break up LIC? No, I don't think so. We just need to give it competition. And in the pension side, given the fact that unfortunately the actuarial discipline, which obviously feeds into both pensions and insurance, has really not developed in India in terms of enough business schools teaching students enough about actuarial science so they feed into our insurance and pensions industries, and we allow those to grow. Of course, as you would rightly point out, that it's ultimately up to government to let go a little bit in terms of the norms it has, not, as I said, to privatize LIC because that's a political issue, but to give it more competition. And in the pension sector, I think at some stage, EPFO at some of these institutions, EPFO I think is sitting on 3 lakh crores, professionalize it a little more in terms of the way it manages its funds and so on. I think a mention has already been made in terms of how the international financial architecture is changing in terms of the new institutions which are coming up. And I would like to particularly point to AIIB, and with that I'll stop. I think it's important for us to look at the capital structure when we keep harping on the World Bank and the IMF, and for that matter, the Asian Development Bank. The capital structure of AIIB is larger than that of the World Bank. So it's a different matter that whether it would be able to borrow enough in international financial markets, given its current credit rating, to be able to lend within the parameters it has set for itself. But it's worth watching out for. What does it do to the global financial architecture? Nothing much, except that it creates an alternative for those who are looking for liquidity. By those, I mean essentially governments, because in this case, it will only lend to governments. I'll end on the note that the G20 came up at the level of summit in a kind of a firefighting mode. When there is no fire, everybody becomes a little complacent. And I'm not even sure that a G20 needs to meet at a summit level every year. Should it have more specialized bodies like the FSB with enough of a mandate and budget to do more? I think so. And I'll just mention one area in which it's just one area, just comes to my mind, accounting. We all remember the Satyam fiasco. Price Waterhouse was fined in the US by SEC. None of our bodies fined Price Waterhouse. We don't know what is the situation in a bank if you don't know its financials. And if you have banks which have multiple countries in which they work, and the accounting practices are disparate, how do we know what's going on ultimately in that bank? So I'll end with that thought that maybe instead of having first pushed it up to the summit level and then the governments gave it the fiscal push it required in terms of the international economy and liquidity, I think the demand or the need of the hour is more specialized institutions working at the nitty-gritty of things like accounting. Thank you so much for your attention.
Thank you very much, Dr. Bhagwat. We will, as usual, take 5 questions and then request the panel to respond, and after that, I'll try to make some closing observations. Where do we start? Yes, please. 1, 2. Right. Mr. Data, okay. 3, 4.
Mahendrapal from Delhi University. The first point related to Professor Asima, she talks about that distinction between IMF research and academic research. I think IMF policy may be different, but so far the IMF research is concerned, I think it is done by the economist appointed by the IMF, and these are all, anyway, I think it is up to you to answer. Second point relating to Professor Rakesh Mohan, I think he talks about the IMF and World Bank, and these two institutions have not been responding to the requirement of the developing countries, as he says. But I want to make 3 points. First, I think they have changed themselves to the requirement of the developing nations during the last 60 years. I'm not going to go into further details. I think the number of details and responses there. First point is the World Bank president is different now. It is from South Korea. Second point, so far their quota and voting power is concerned, I think the developing countries, their voting power have increased. Third point, which is more important, that is these institutions are based on weighted voting power. That means you take one vote and pay more money for that. I think it is in the long-term interest of the developing nations. If we want to dismantle this kind of formula, I think they will be turned into UNCTAD and GATT. I think it is not in the interest of the developing countries. Thank you very much.
Thank you very much, sir. Second, yes, please.
I'm Kumar Vijay again from Delhi University. Sir, from Rakesh Mohan's slide, this China versus India, 1980 versus 2018 column, if we look, just one question arises, where we have gone wrong. When most of the parameters, India's figure was better, in 2018, how it has been to that extent worse. So from financial architecture point of view, policy point of view, I expect little more deliberation on that.
Thank you very much. Mr. Data, please.
It's indispensable even, and it's free of charge because the US doesn't pay for it. It's the customers of the IMF that pay for it, which is often forgotten. I have a question to Professor Goyal on money flowing to China. Is it possible that there is quite a bit of liquidity flowing via hedge funds to the shadow banking system in China, which is then used to finance real estate investment, the collateral of which is land, which you cannot sell in China. So essentially, we have hundreds of billions of dollars which are flowing to China for, let me put it like that, dodgy purposes. The Economist has suggested that China has become, and I'm quoting The Economist, a gigantic Ponzi scheme. Is that worrying you? Second question to Mr. Mohan, and the question of leadership in international governance I think is very important. An economic historian has recently come up with a suggestion that there is a strong correlation between the level of competitiveness an economy has and its interest in providing an open trading regime. Put differently, Britain was initially an imperial power, and then when its competitiveness increased at the end of the 18th, beginning of the 19th century, it suddenly turned to a liberal trading power, but before that it wasn't. Keeping that in mind, would it be, in your view, possible that a substantial modernization of the American economy, which is of course possible but also needed, could result in an increased interest of the United States government in the future in an open trading regime, which it currently doesn't seem to have. Thank you.
Very much. Dr. Shamcharan, please. Mohan Bhattacharya ji.
Yeah, I don't mean to answer Rakesh's question that was asked, but I was just tempted to make a few points, having fought side by side with him. So I think a few things that are even more striking than the numbers that Rakesh put up. Emerging markets and developing countries now account for 60% of the global growth. They account for 87% of the world's population. So in terms of both the democratic nature of global governance and also the power of the economy, I think the proportions have changed, but they have changed very, very modestly. So then the question arises, why do we need to have a change for what result? And I think 2 points for the IMF and the World Bank are important. On the case of the IMF, there has been a perennial debate about the size of the fund and about the instruments that the fund has to help emerging markets when they face financial difficulties. And I'd appreciate, Rakesh, if you could elaborate a little bit on why, therefore, governance matters. And in the case of the World Bank, with which I have been more involved, it has been very much about blocking, in some sense, the capital increases of the multilateral development banks, where the advanced countries have felt that it's not needed, but the emerging markets and developing countries, of course, have paid the price for it. So governance does matter, and I'd like to therefore support very much Rakesh on that.
Thank you very much. One more question, last. Okay, there are 3. Okay, all 3, quickly. Telegraphic language, yes, please.
Sir, IMF was designed for handling trade imbalances, and trade is in dollars, mostly is in dollars. It's a dollarized world. Should PPP be used as a reference point for comparing the size of or the success of countries in a inter-country comparison? PPP is okay for a domestic material improvement and all that, but an inter-country comparison, should it not only be simple dollars?
Yeah, my question is to Ashima Goel regarding this shadow banking. Do you think this the way money laundering and NPA is because of private banking, this is the only way out for merger of banking or something else?
Yeah, Suman Berry, I've introduced myself before. Just some quick observations from these very diverse presentations, including you, Chair. We've, in a sense, talked a lot about finance, but we've not talked about the global monetary system. Immediately after the crisis, you were involved in the Stiglitz report. Padua Schioppa has basically argued that what we have seen is the non-viability of a fiat-based monetary system, which has also been associated with repeated banking crises. So while focusing on finance, are we ignoring the whole money side? And is there any appetite on monetary reform? The second point I'd make is that, the US was a hegemon which was very comfortable with rules designed for others from which it was accepted. So American exceptionalism has been, as it were, at the heart of the post-war system. And the question really is, will what will follow be Chinese exceptionalism? Is that what the Chinese are after? Or are we aiming for a system which would apply equally to China and to the United States? Of course, the United States will not be as docile in giving up its hegemonic role as the Brits had been, but I mean, I think it's worth looking ahead at that. From all the expertise in the room, how has the fund been affected by the whole experience in Europe, as it were? What have we learned from that? Yes, the ESM now exists, but what have we learned about even-handedness? What have we learned about, as it were, the application of rules? Thank you.
Thank you very much, sir. I think I'll request the panel to respond as well as supplement as needed. Professor Goel, please.
Thank you. First of all, this distinction between, I was not making a distinction between IMF and academic research. I only said that I was drawing from IMF and academic research. And IMF research itself suggests certain criteria on what rules are effective in what circumstances, which have not really been followed in implementation. Then Dieter, is your question about shadow banking in China, and I think Ratna has been telling us the Chinese administrative system is admirable and responds very quickly, so they seem to be on top. In 2013-14, we were really worried, and it's not, things have sort of sorted out. But it does just illustrates the argument I was making, that the way regulations have been implemented, the way mutual funds, hedge funds have grown, it is because regulations are focused on banks, so then it obviously leads to arbitrage and leakages. And for global stability as a whole, this kind of leakage should be stopped and regulations should be more universally implemented, simpler types. Then this question on NPAs and shadow banking, Indian NPAs, these are distinct questions. Indian NPAs are not really due to shadow banking. It's more due to loans for infrastructure in a situation where we had a poor credit culture and there were various other delays. So they are not actually, in India some people say we have large shadow banks, the non-banking financial system is a shadow, but I think the issue here about regulations applying symmetrically is perhaps relevant to some extent. That's the one issue where we need to improve perhaps in India. So I think those are all the questions addressed to me.
I don't remember any question being addressed to me. I thought it was Dr. Mohan, but since the chair has given me the microphone, there's one point which I forgot to mention, which is Mark Carney is the governor of the Bank of England and he's also the chair of the FSB. But in his letter, which is a kind of a recounting of what he thinks are the issues that confront the G20, he didn't make any mention at all about Brexit and the fact that London, whether some Europeans accept it or not, is the world's one of the world's, at least, most important financial centers. And if and when the UK leaves the EU, what will, I'll just mention one technical point, which is which index would be used for interest rate swaps? Euro LIBOR, which comes out of London, or Euribor? So there are lots and lots of these issues at a micro level, which I think the FSB could help, if not resolve, at least throw light upon. Thank you.
Rakesh,
Thank you. There are a number of questions. Let me first quickly deal with some of the specific ones. One correction, the president of the World Bank is American. He is of Korean origin, just like Mr. Kissinger is of German origin. Doesn't make him German, he is American. And the President of the World Bank is American, and so far, the convention has indeed been that the US President names the World Bank President, and he's also demonstrated his Americanness by authoring a joint article with Ivanka Trump recently in the Financial Times. So there should be no doubt on which country he belongs. On the weighted voting, if you look at the handout of my presentation on page 14, it gives the proportions. So that if you calculate GDP through market exchange rates, the weight of BRICS is about 21%, 2013. The weight of European Union put together was just under 24%, but the quota share after the 2015 revision, as opposed to 21% GDP share of 14.8, of 21%, the quota share was 14.8 for the BRICS. For the European Union, with the weight, similar weight of 24%, just under 24% on the market exchange rates, their voting share was 30%. If you take PPP, of course, it's even, the difference is much worse in that the weight of the BRICS was 30% in GDP, in global GDP, and of course the quota share 14.8. European Union weight was only 18% in PPP terms, and weight was 30%. So the point of these numbers is that it is very, very clear that Europe has a much higher share than any weighting you do, whether you prefer market exchange rates, you prefer GDP in terms of PPP. It's Europe which is a much higher share, which is reflecting the immediate post-World War II power situation. What is also interesting here is that the US is underrepresented in that sense compared to their GDP share. And so in a way, one of the issues, by the way, that is going to arise in the next 5 to 7 years is that if, depending on how the formula is used, that the Chinese GDP share is going to exceed the United States within the next 5 to 7 years, if it already hasn't done so. By the Articles of Agreement of the IMF, the country with the largest share has to have the headquarters of the IMF. So if we go by articles, it's very difficult to amend the Articles of Agreement. So this question is going to arise. Is the IMF going to move from Washington to Beijing or Macau or Hong Kong or Shanghai? And I say that partly in jest, but it's to focus on the point that a big change is taking place. Second very specific question was on whether we should use PPP or market exchange rates. Now the IMF uses PPP in all its comparisons. So to my mind, yes, there are arguments on either side on whether you should use PPP in comparison market exchange rates. But my point of view is you basically get similar answers. The difference there are some differences. On broader, I'll just end up with Dr. Reddy is getting very impatient, and I'm known through long practice on when he gets impatient. So I can see those signals here, and then you're in trouble if he gets too impatient. So that is true of the banks also in the country during that time. I think that I want to reflect on the very broader question actually. Why do we need these global institutions, which Amar essentially raised? That's a difficult question actually. That one answer is that given the current global monetary system that Subramanian referred to, the current trading system, the current system of relatively open capital flows, there's no question that we will continue having financial crises. We've had more than 100 in the last 30 years. We did not have such crises when there were fixed exchange rates or when we were in the gold standard. The likelihood of moving to those standards is near zero. And therefore, there is almost no question that there will be a continuing financial crisis around the world. So you do need some agency like the IMF, if not the IMF. Now, what is also interesting is that the European system after the European crisis has set up the ESM. Now, when the Asians were proposing a similar Asian monetary fund after the Asian crisis, IMF revolted, the West revolted. Here, they very happily accepted the ESM. So again, there's a difference in view on how you treat countries other than Europe and the US. But my point basically is that to my mind, we need global economic organizations, whether it is WTO to govern the world trading system. You don't want hundreds of bilateral or regional trading agreements for global efficiency in trade and the economy. You do need some institutions to provide some relief when there are crises. And third, coming to the World Bank, etc., that there is need for global institutions to provide very long-term financing, particularly for infrastructure. And the emerging markets will continue to need very high levels of financing for infrastructure, which today are difficult. And so I do believe that you do need global institutions of the kind. Now the question that I'm raising is, how is the new global changing power equations going to affect the governance of these institutions? And if these institutions don't change enough in the kind of power structure that they have, there will indeed be different institutions coming up and difficulty in global economic governance.
Thank you. Subramanian, please. Thank you very much. I will take my 10 minutes, 5 minutes in the beginning and 5 minutes now, 10 minutes. First, I think, Professor Goel, I think there's a very important point you made about the debt dynamics, but I think one of the things we may have to look at is two things: concentration of risk in the public sector, because banks' balance sheet is weak, the government's balance sheet is over-leveraged, the large corporates are over-leveraged, the households are highly under-leveraged, the external sector, in terms of trend, is net external sector position is slightly deteriorating. So in a way, if you take the totality of the stock situation and the balance sheet, I think we have to be a little more careful, though the flow data is comfortable. So I think that concentration of risks, I thought that as a supplement to what you have done would be very good. I think that Rakesh Mohan has been mentioning about the governance of the IMF. Yes, but I'm not so sure whether the dramatic change will happen because of the possible difference between the activity can shift, the real sector activity can shift, if the financial sector activity does not shift. So if there's a global power concentrated economy in one country and the financial power is in another country, that can be a source of a tension. So that transition, so I think I would be a little more careful about how it will sort out. But I think I agree that change is necessary, but how it is, I think that will be worth exploring. But I'm glad that you covered the other organizations in your response. Professor Subramanian had raised the whole issue of lean or clean plus capital account management. And I think the lesson simply is however much rules globally you are essentially handling a messy situation, whatever it is. I think that's an important lesson that we have to, and Dr. Jamini Bhagavati, I think the most important point I would take from his presentation is the nature of interaction between financial markets and banking institutions. And it is a link. Even the advanced economies in a way neglected that. And that's how they landed up in problems. And because naturally, whatever you may say, you regulate the institutions, you regulate the markets, but the interface is a problem. And that's generally people miss out, and I would definitely say that has not attracted the attention, perhaps, that it should. Now, coming to summing up my own views of the totality of the situation, evaluating global financial architecture. What is the global financial architecture? In my view, there are 3 pillars and 2 supplements. 1, IMF. It's a legally binding institution on all countries. 2, World Bank. And 3, WTO. Now look at what has happened in the last 10 years. That's all evolution. Has it happened? Much happened. A lot of talk has happened. So we have to evaluate, and I think we know what it is. But the way we have to look at it is IMF, World Bank, WTO at one level. The other level, which is voluntary, is G20 and Financial Stability Board. So these 2 are again different types of animals, but they are, in a way, they are operating through these institutions or the concerned countries, except the difference is Financial Stability Board is operating more through the national governments. Now, the way we may have to look at it is what has been the change in the structure. IMF to some extent, WTO nothing as far as the structure is concerned, the governance and the policies. These are 3 different things. I think in the policies there has been significant change perhaps. So in a way we have to evaluate how these things are coping up, A, with the new realities, and B, with the lessons of the global financial crisis. And if we compare, and I think the most important, I forgot, the related most important is international monetary system. And I'm glad you pointed out most of the problems of global financial architecture cannot be understood without understanding the international monetary system. There are 2 distinct things, but the global financial architecture operates in the context of the international monetary system or non-system. The non-system is, let us accept that in the world there is one supreme currency called gold. And next to gold, it is US dollar. It is true we had discussions in Stiglitz Commission, we had discussions in Palaroil initiative where Paul Volcker, De La Rosier, Lamfoussi, name it, they're all there and we participated. We made the recommendations, mix of currencies, et cetera, et cetera. But in reality, if you ask my frank opinion, unless there is a global government, which is unlikely, there cannot be a global currency. I'll come back to Europe. There is unlikely to have a global government, there cannot be a global currency. If there is not a global currency, multiple currency cannot be a final unit of settlement. It can be accounting. So in the final analysis, in the absence of a global government, one country's currency will be the settlement. Whether it will be USA or whether it will be China is a matter of, there cannot be any other way in which the international monetary system can operate. Whether it is an exorbitant privilege or not an exorbitant privilege is a different matter. The second issue on which you can have. And I think we have to be very clear the way forward is not a multiple currency in the way in which you look at it. And if you take the example of Europe, they tried to have a currency and no European government. So when the IMF goes, usually the IMF and the rest, and here you had a ECB almost either with the IMF or with them, and you don't have a situation where other actions can be taken to support the currency. And the European experience of IMF's presence in Europe is huge, it's very interesting. 2007 IMF was broke, they couldn't pay the salaries, as you know. They were broke. In fact, global financial crisis got income for the IMF. And Mervyn King at one stage had said we should wind up IMF. And I agree with Dr. Rakesh Mohan. I told him that you never know, you can't create an institution. You keep it safe. So whatever we do, we have to keep the institutions. And having parallel institutions, I'm not sure, but anyway,